everyone, welcome. Thanks for joining us. We're here to talk about real estate, which as you know is going great, so this will be very short. I just want to start with you, Marcus, as an asset owner here. You run the Alaska Permanent Fund, very large public quasi-pension fund. You own a lot of real estate, so at a very high level, what have you seen? What keeps you up at night? And then, have we seen the bottom? Like, where are you starting to spend?
Sure. So thank you, everyone, for coming. When I agreed to be on this panel, I didn't know we were up against Titans of Wall Street is another competing panel right now. So I guess everyone here felt like we had more to say than the Titans of Wall Street, although Julie just won a big award, so I consider her a real titan. Anyway, on the real estate side, so we like real estate. We've increased our allocation in the last year. We felt a year ago like we had too much equity risk in the portfolio, so we increased fixed income with the higher rates. We increased absolute return hedge funds for like the non-correlation, and then real estate, we increased from about 10% to 13% target. So we like it. We'd like to see cap rates get up a little higher above where yields are right now, and boy, is the world changing fast. Like a few months ago, when the 10-year was touching 5, it seemed, fundamentally unattractive to buy stabilized apartments at, for the very high quality properties that we would target, like mid-4s cap rate. That just didn't seem right with REITs at a discount to privates. So patience has been kind of like our ethos. So we want to get bigger in real estate, but we want to take it real slow and get there over a multi-year period. And then like right now, we're very active on the development side. We feel like there's some good projects where the sponsors might need another equity partner to come in, and maybe they're somewhere along in the construction where it's somewhat de-risked. So we really like development and we really like lending. So we've got a big real estate lending separate account and a big JV on the lending side that we just entered into. So those are a couple of areas that we've been able to be active without going out and bidding on like trophy stabilized properties.
I'm gonna click on that for a sec because you've got sponsors who, really are kind of having to choose winners and losers. Do I put more equity into this thing? Curious how you think about that across the portfolio. At what point do you, I'm sure you don't have any of these assets, but do you say this is just good money after bad? How do you think about coming in as an equity partner to help some people out?
Oh yeah, we just did a partnership with CBRE on the life science side where there was a big, well-established pension in there, and the project would benefit from someone else in it with some deep pockets. So we're not going after like office or like distressed opportunities in real estate. It's not really our strategy. We more want to just get into like really high quality properties and hold them for decades, but maybe have a little bit lower cost basis by coming in on the development side.
Greg, I want to talk about financing a little bit. Last spring we lost a couple of big regional banks. Cost of capital went up for everyone else. Margin's been squeezed. Everyone, I think on the bank side, is running a little bit scared away from this. A lot of real estate debt sits on those balance sheets. CMBS market is what it is. Like when you think about where the next dollar that you're going to need to develop these properties and run them and finance them, where's it coming from?
Yeah, there's no question 40% of the lending market in a traditional commercial real estate lending environment where the market's working, 40% of the capital typically comes from regional banks, community banks, national banks. The CMBS market, the CLO market is typically a functioning market. It's not been functioning as well last year. Now it's starting to pick back up. And I don't see banks necessarily coming back in at the level that they were, say, pre-pandemic or even a couple of years ago in the middle of the pandemic. So I think, unfortunately, banking in general is going to be, very soft going forward for commercial real estate lending. But I think there's a huge opportunity set, for groups like us that are doing lending to groups, as well as we're getting capital and looking for capital. There's still capital out there. It's just at lower leverage points. So ultimately, we're having to take on less leverage for the equity in a project because there's less debt capital available unless we want to go to a non-traditional lender, and the cost of capital in a lot of cases is much more expensive.
And obviously, lower leverage is going to change the return profile. So how are you thinking about where you're raising money from and really your marketing when you sort of go out and pitch the model?
I mean, I think it's just putting pressure. Clearly transaction volumes have been down because you need more. If you're acquiring assets, developing assets, it's hard to do it. It's hard to basically have a functioning market if you're getting 50% leverage, or if you're taking on 60, 70% leverage at much higher spreads. And so it's just caused a reduction in the volume of deals. Like the transaction market's down over 50%, last year on transactions. So,
Julie, I want to talk about office for a sec. You've all seen the stats. On a good day, the average office tower in a top 10 city is maybe half full. I think one sort of bigger question hanging over lots of parts of the economy is how much of the stuff we saw during the pandemic and the behavior shifts are permanent and how much are starting to come back. We were just talking backstage about some layoffs this morning, and I saw a headline about IBM saying butts in seats. So I'm curious kind of when you think about where that number will settle and what that means for financing, refinancing, and leasing these buildings.
Well, not a very popular sentiment, I would say, but we think net reduction will be around 30% reduction in demand for office space. And that will take, similar to retail and what we saw in that secular demand shift, that'll take another 5 to 10 years to work its way through the system. So folks, hybrid's here to stay. And it's not about work from home or remote. This is a densification story that was happening pre-COVID. One of our claims to fame on our open-end core side is we underweighted office pre-pandemic just because we saw the cost to acquire that tenancy start to go up because you just had too much supply. So your classic supply-demand real estate story, thrown in behavioral shift, thrown in some technological advancements such as the laptop. You can work anywhere. And here you have a perfect recipe for a lower demand for office, that densification story playing out. So people love to talk about, the return to office is going to solve the office demand story. Our view is this really a densification and too much supply, and that'll just take 5+ years to work through the system. So, I think it's nice to say that there will be some UPSs and IBMs requiring butts and seats, but the cat's out of the bag, and I think the American, workforce has said their piece on what they prefer, which is undeniably hybrid. And that's not great for office nor liquidity.
And the average, what kind of like lease expiration are we going to see over the next few years? Because I think companies spent 2020 trying to figure out what's going on, 2021 being like, everything's going to be fine, 2022 kind of reassessing their footprint. Like, where are we going to see landlords start to have real problems?
Well, that's the good news. The good news is people finally have to make decisions, and they finally feel like they have the data to make a decision that, okay, I do need 20 to 30% less of my footprint. I now know what my employees want in terms of amenities, a live, work, play environment, a vibrant location, some health and wellness benefits, maybe yoga and doggy daycare on the bottom of the building. And so now tenants know what the amenity is, not the cubicle farm, but the amenity that's required to get their workers back in seats. And so they can make those decisions. So you will, instead of those 1-year, 2-year extensions, which for an office landlord is death by 1,000 paper cuts, we're finally getting 5, 7, 10-year deals. It's just smaller footprints, and we have to have everything, and including the doggy daycare and the brewery at the bottom, right, to attract those tenants to come and renew and stay at our building.
Got it. Drew, you saw those same pandemic movements on the residential side. Tell us a little bit kind of about your business, but also I'm sort of curious. The very obvious, everyone left New York and went to Miami.
Right.
I don't know if you heard. But are they staying? How are people sort of thinking about the permanence of that, layered on top of the fact that a lot of, we were kind of making fun of millennials earlier, but are just sort of more flexible transient people, a generation to begin with. So what does that all mean for single family rentals?
Yeah, so I would say that there's been and Julie said this, right? There were a lot of themes that were already in place that were just massively accelerated because of COVID. So people were already looking to move to more affordable places, and then all of a sudden COVID really sped that up, right? When all of a sudden their employer can say you can work wherever you want, people took their laptops and went to a more affordable place, generally out of big coastal cities, and into the southern Sunbelt markets and here in Florida. I'd say that, you really need to do, and the writing will, looking back, I think it's going to be very, very interesting to see what is actually sticky. So if you look at a place like Florida overall, now I'd say that South Florida is a little bit different than North Florida, but Florida overall has been much more sticky in terms of the jobs that have remained in Florida versus a place like Phoenix, Arizona. So if you think about the price point of the jobs that got relocated down to Florida, a lot of financial institution jobs, high paying, high earning jobs where the frictions to actually move that job are much more than the entry level job that you saw come out of California into Phoenix. There's more frictions to actually move that back. And so in our portfolio, we've seen more lower retention in a place like Phoenix versus our Florida markets. And I attribute a lot of that to, again, this idea of it going back, kind of what that relocation that we saw post-COVID, some of it migrating back to where it came from.
And what's your sort of uptake on renewals?
Renewals, so during the pandemic, it was the boogie monster. No one wanted to go outside. So if you had a nice place to live and rent was affordable and you could pay it, you stayed. So our renewal and retention rate went up significantly in 21 and 22. It's come back down over the last year or so. However, we're seeing that level out and actually increase again. And a lot of that increase now is not due to massive demographic shifts, but it's really the gap between the affordability or the math on owning a home versus renting a home. So historically, about a third of all people that would leave a single family rental unit would move out to go buy a home. That number now is coming drastically lower every quarter. So on average across America, it costs about 35 or 40% more in terms of a monthly payment to own a home versus to rent that same home. And so that's obviously going to help retention and have a more stickier demographic and customer base for us.
Obviously, a lot of the problem here is supply. I want to talk about the people for whom the opposite is true. You have a whole generation of people who bought or refinanced in a period of incredibly low interest rates and now have these golden handcuffs to their houses. So without asking you to pick where interest rates are going to be or what the Fed's going to do tomorrow, where does that curve have to go for the math around renting versus owning to converge again? And what does that mean for how you kind of finance the portfolio?
Yeah, you really need to see. So my guess is a lot of the audience, right, would have guessed that home prices would have been down if I said within 18 months, the 30-year mortgage rate would have gone from 3 to 8. In fact, just the opposite happened, like you said, the golden handcuffs, where all of a sudden the consumer's asset moved from their home to the mortgage that they had on the house. And so they're going to do everything they can to keep that mortgage. And when you think about like how far do rates need to come down before the value of that mortgage really loses its golden handcuffs effect, you really, right now, mortgage rates bouncing, around 6. You really need another 100 to 150 basis points before that really starts to unlock some shadow inventory. And so our view is you're not going to see an overwhelming amount of supply come onto the market. Mortgage rates are largely back to where they were about 12 or 14 months ago. So we had a massive run up, obviously, in the middle of last year. Now that's come down, but it's only come down to where we were 12 or 14 months ago. And 12 to 14 months ago, there wasn't a lot of supply that came onto the market. So I would still anticipate as we go through the next couple of years, really a supply constrained market where this technical dynamic of no supply, and even though there's a lot less demand at these higher mortgage rates, prices are going to move up versus fundamental prices should move lower because of the affordability math.
Marcus, you were saying you like construction risk. Bold choice. We'll talk a little bit about that, because a lot of the problem is there aren't enough new houses being built. We're obviously not going to solve the policy problems here, but there's a sense, I think, that if there was more financing available on more generous or at least flexible terms, perhaps at scale with a partner like Amherst, getting into the primary game, perhaps, like how do you think about new money going into particularly residential, where it's needed?
Yeah, I mean, that's a sector we've been investing in on the new development side. I think it's just that I find where stabilized assets are to be like somewhat unattractive, where the cap rates are. So like we'd rather build to a higher cap rate and accept that risk in the construction period. And I mean, all the data would suggest that there's not enough units coming online. There's not enough existing units. So it feels like there's an opportunity to pick some good markets and get money to work that way, you know, and we're at this point, we have a portfolio of around 10 development multifamily projects around the country. So like if, you know, you have some diversification, it would be a mistake to, you know, make, in our position, to make like a more concentrated bet on one market or something like that. So
And I would say with the rates Greg is charging on construction finance,
Right.
Greg, you know, that's really constraining new supply. And although we've got this wave, right, from the free money days coming online, once you work through that pipeline, it's very expensive and very, I would say, difficult to get a construction loan. So money that can do it, where you can finance it and still come out at a, you know, a nice little 17, 18, like we, gross levered return like we get in the olden days, is tricky, right? To get that math to work on cap rates, to get that math to work after Greg's high cost of debt on the construction side. And that's what we're really excited about, either building to or owning those assets in the markets where there's just going to be fundamentally constrained supply, not this year, but over the next couple of years. And I would say the same not only for multifamily, for single family for rent, for student housing, for logistics, where you did have a supply boom, and that'll be severely constrained over the next couple of years.
Yeah, I was just going to say, I mean, I think construction is probably the most, like investing in development deals right now for across a lot of different property types is super compelling. It's not to say go out and just take a macro investment thesis and start, you know, overbuilding per se, but if you can support building a project today, if you're a lender, in most cases you're getting paid, you know, pretty high spreads, so you're getting, it's mispriced risk. You're getting better spreads doing construction, and you're lending to assets, you know, at lower leverage points. You're coming in at probably better debt yields on a stabilized basis. I mean, you're taking on stabilization risk, but it's definitely well worth it. And if you're investing on the equity side, if a development project is pushing forward, I mean, the yield on costs, you know, at stabilization is pretty attractive compared to what you could buy right now in the marketplace. So,
well, especially at a 50 LTV.
Yeah, exactly.
I'm going to do some business in the back. Is the problem, though, the ultimate sale and rental price? Because you're charging what you charge, I assume, because you've got to beat money markets at 5 and double-A corporate bonds at 8 or 9 or whatever. That ultimately that should get passed through and should be recouped in higher sale price or higher rental price. So where is that broken?
Like, where are they getting the yield on the equity side of the table?
Julie wouldn't be so mad about the rates you're charging if she, you know, if ultimately you were bringing in more on the back end.
Yeah, I mean, and we're doing, like, when we're doing lending now, when we're a borrower, because we develop stuff ourselves, if we're borrowing capital today for development projects that we're doing, I mean, we're usually getting 50% leverage. Now, when we're lending money, usually we're probably lending at 65%, so we're going a little bit higher in the capital stack, but we are getting paid for it. And ultimately, most sponsors that are borrowing from us, they're looking at it as a short-term fix to get the project open and hopefully open it in a market where, you know, debt cost is much lower and they can refinance in a longer-term vehicle at a much cheaper rate than what we're charging.
Okay.
But to answer your question, Liz, an untrended 5 is now an untrended 7, right?
Okay.
The cost, the yield that you're going to build to has gapped out considerably. And your price of your land has come in to help you get there.
Okay.
To that yield.
I'll do a little bit of a lightning round, and then we're going to end on everyone's favorite topic, which is AI tech. You know, between, let's say, office, residential, commercial, and hotels, I know a big thing there. Like, I pick your multifamily, pick an asset class, go down the line that you feel good about in 2024, and one that you just would not touch. Start with.
So our big theme is technology is really eating real estate alive, right? It's transforming how consumers use real estate. So kind of along those lines, the home, the house where you live, you're doing a lot more. So consumer demand's going to be there. The product for more space at home is real. So I think residential is in the obvious pro camp. And I think there's just a lot of questions on office. I think Julie summed it up well. But the amount of excess supply, I think that's going to take years to work through. Doing conversions from office buildings to residential, which you hear, like they can be done, but they're very difficult and they likely need a lot of cooperation from local governments and subsidies to actually make them work. So it's not just wave a magic wand and all of a sudden you can move all the office space into residential where it's highly needed.
Yeah, I think hotels are super compelling in this environment just from a standpoint that there's an imbalance of supply being built. I mean, due to COVID, due to the current dislocation in the credit markets, there's just a lack of new supply. Supply is growing at less than 1% a year, which historically is growing at about 1.6% a year. There's a lot of just secular trends that favor travel. And ultimately, I think hotels are well positioned, not to mention they trade at higher cap rates. So ultimately, in this environment where you're dealing with higher interest costs, which I expect the 10-year treasury rate to remain higher for longer than what we've experienced over the last 10 or 12 years, where the 10-year treasuries average closer to 2%. I think it's going to stay closer to 4%. I think hotels make a better just investment altogether, and I'd probably stay away from office, just given all the secular distress and the challenges with just the CapEx needs and everything that goes into an office building.
Yeah, so one sector we've been leaning into is life science office, so like lab space, and the numbers on development work really well where rents are now. The biotech sector, we think is kind of troughed, is in recovery now. So we like that area. And then the thing I'm bearish on, that I'm expressing bearishness, is transaction volume's gone down on very high quality apartment and industrial. And so there's a bid-ask issue, and I think it needs to solve to higher, lower valuations, so higher cap rates. So we're definitely avoiding that area right now.
I would say, the commercial is we're big investors in life science and single family for rent, and we love all things residential, but our number one conviction bet, I would say at this moment in time, is modern logistics. So everything we all fret about when we think of when the Fed is going to cut, when are they going to cut, is labor supply. And when you think about our logistics warehousing in the US being on average 40 years old, the product we have in the US will not support the seamless slab you need for robotics, or the ceiling height, or the roof loads for the solar, or the battery storage. Heck, on a new logistics development, you can't even reliably get power to your building today. So those of us who can get access to power, who have those assets, have built them. What we're seeing on the rental side and continuing demand is unprecedented because the stock in the United States is so old. So we're hugely bullish on modern logistics, and we're just seeing the rent growth and the demand from our occupiers.
And how much of that is, the simple sort of read through is e-commerce, so that a lot of that sort of last mile, the Amazon, I guess we'll all be getting packages by drones.
It's more
but how much
of a
is
labor
tied to
story,
that?
right?
Okay.
And of course, labor, the e-commerce penetration in the US is still in the 20s, and most industrialized nations is closer to 30. So we have a ways to go. But this isn't an e-commerce penetration story. This is a labor shortage story. This is how do we make our supply chains more resilient and less labor dependent, right? So we can afford to move product through our supply chains. That's the story, and that's what the logistics stock in the U.S. is not prepared for.
And where is the source of capital that is friendliest to that idea and understands, frankly, the technology? And to your point, you got to have power supply. You got to be able to deal with local regulations. You have to understand the technology. You have to be willing to spend a lot before you get a lot. And ultimately, your clients are going to be the ones saving. It's a complicated financing arrangement. Where does that money come from?
Well, I would say we've found the best audience with those who are also investing on the private equity and robotics side, on the venture capital side. So those sophisticated investors who have that purview across their book love this, and also those of us who have, so we manage $150 billion globally. We have a massive global logistics warehouse presence, and that enables us to work with the most sophisticated occupiers that solve their needs, whether it's in Amsterdam, whether it's in New York, New Jersey, in the Empire. That is I think, a key advantage with today's sophisticated occupier who needs that type of new world space.
Okay. Sticking with tech for a sec, Drew, you were saying that sort of tech is eating real estate. It's an incredibly liquid market in some ways, and yet doesn't really trade like one. Curious we've seen some platforms try to get more into the programmatic game. It's obviously been tough. Sort of curious where you think there are opportunities to take some of the friction and the costs out of the system, and ultimately you operate at scale. So how do you buy these houses one at a time without wrecking your model?
Yeah, so it's a heavy dependence on technology, data, analytics to go. We have about 50,000 homes across the country, and about 40 or 45,000 of those homes were purchased one at a time, repaired one at a time, and leased one at a time. And so it's this powerful combination of technology, data, analytics, but it's paired with the human. So we have 2,000 full-time employees, and these are employees that go and underwrite homes all day. They go and inspect homes, they repair homes, they lease homes, they do service calls to homes. There's a number of efficiencies, kind of going down the AI route that is more machine learning over the last 8 years that's been embedded heavily into our business. But with the advances in AI, there's going to be an exponential catapult forward in efficiencies that we're going to be able to drive. Now, there still isn't anything more powerful than the human brain. Like when you go stand inside of a house, that human brain will pick up on things that the best AI technology won't be able to do. So we're still a big believer that there's a heavy human impact that will always obviously persist in our business, but there's a ton of room for efficiency gain through more and more technology that's available to us.
Are you able, and I think Delta Airlines can tell that bolt's going to need tightening when it gets from Nashville to Atlanta. Are you able to say, you know what, that faucet needs to be replaced, we should have it, how far are you away from doing that? And is that actually really the ultimate end game? Is that actually valuable?
We can tell you across our portfolio how many faucets in all likelihood we're going to replace this year. We can't tell you what house is going to have a faucet that's replaced. But having that data, having that technology, it ultimately enables the consumer a better experience, right? We were talking about this earlier, a lot of our customer base are millennials, right? So these are somewhere between late 30s, early 40s, head of household, and they expect a different quality level of service. They're rolling out a multifamily where they don't have a screwdriver, they don't have a wrench.
Uber, but for plumbers.
Uber, exactly. Yeah. So that's their expectation. And given the fact that millennials in this country are flat out insolvent, they're not going to be buying homes anytime soon. So, we need to figure out how we provide them the services, and that's a big part of our value proposition for our customer base.
It's interesting because you're sort of structurally long some of the other financial kinks in the system, right? You have a generation coming up that's carrying a ton of debt, that has had lower wage opportunities for a long time, is at a lower point in their career than other generations have been. I'm sort of curious what you make of big demographic trends and how that shakes out.
Well, we only got a couple seconds left here, but let me get on my soapbox for a little bit. The U.S. government is really bad at supporting U.S. citizens who work but don't have savings. If you don't work and you don't have savings, there's subsidies. If you work and you have savings, they'll give you a mortgage to go buy your first home. For the 15 million Americans that work and don't have savings, the government doesn't do much. And that's our customer base. And so as you think about providing a set of services, providing a product that's really desperately in need, and these are individuals, right? They're all employed that go and sign a lease. They all have the income. And by the way, their incomes are steadily growing right now, right? It's hard to believe that people think inflation's dying because the average blue-collar worker that is our customer, they're having a lot more income show up this year than they had last year.
All right, we'll have you all back next year and see how the calls worked out. But thank you so much for coming.